Welcome back to Algobot, where we break down automated trading strategies for MetaTrader 5, one idea at a time. I'm your host here at Algobot, and in today's session we're exploring an expert advisor called Dynamic Momentum Index Reversal. This strategy is built around Chande's Dynamic Momentum Index, a clever twist on the classic RSI, whose lookback period actually breathes with market volatility. It's a mean reversion, or counter-trend, approach that aims to fade exhausted moves. By the end of this video, you'll understand exactly how it reads the market, when it signals, and how it manages risk. Let's dive in. So what does this expert advisor actually do? At its heart, Dynamic Momentum Index Reversal is a mean reversion, or counter-trend, system. Rather than chasing a move, it waits for price to stretch too far, too fast, and then looks for the snapback toward fair value. The tool it uses to spot that exhaustion is the Dynamic Momentum Index, often shortened to DYMOI. Now, here's what makes it different from a normal RSI study. A standard RSI uses a fixed lookback period, the same number of bars in every market condition. That means it reaches its extreme readings at the same lazy pace whether the market is quiet or wild. Chande's insight was to let the period adapt. When volatility rises, the indicator shortens its lookback, so it reacts faster. When the market calms down, the period lengthens and the reading smooths out. That single adaptive quality is the whole idea behind this strategy. The expert advisor measures recent volatility using the standard deviation of closing prices, compares it to its own recent average, and turns that into a volatility index. That index then sets the RSI period on every closed bar. In fast, climactic conditions, the oscillator prints its extreme right at the moment of exhaustion, which is exactly where a sharp reversion is most likely to begin. Because fading extremes can be dangerous inside a strong trend, the strategy adds two guards. First, a volatility regime filter that only allows trades when the market is genuinely active. Second, a stretch filter that requires price to be meaningfully dislocated from a moving average baseline, measured in ATR units. Risk is handled entirely with ATR distances, so the system self-scales across symbols and time frames. It's most naturally at home on mean-reverting major currency pairs on the 15-minute through hourly charts, though nothing is hard-coded. This suits a patient, selective trader who prefers counter-trend setups. And remember, everything here is educational information only. Let's walk through the exact logic, step by step. On every newly closed bar, the expert advisor rebuilds the Dynamic Momentum Index from scratch. It starts by measuring the standard deviation of the last few closing prices, using the STD period of 5 bars. It then averages that reading over the STD smooth period of 10 bars to get a baseline volatility. Dividing the current reading by that baseline produces the volatility index. A value above 1 means volatility is above average. That index sets the adaptive period. The strategy takes the base period of 14 and divides it by the volatility index, then rounds the result and clamps it between the MinPeriod of 5 and the MaxPeriod of 30. High volatility shrinks the period so the oscillator reacts quickly. Calm conditions lengthen it, so it smooths. Finally, it computes an RSI over that adaptive period. That's the DYMOI. Now for the entries. For a long, the strategy detects the DYMOI crossing up through the oversold level of 30, turning back from exhaustion. For a short, it detects the DYMOI crossing down through the overbought level of 70. But a cross alone isn't enough. Two guards must also agree. The regime gate requires the volatility index to be at or above the ViThreshold, so the adaptive shortening is actually engaged. The stretch gate requires price to sit at least MinStretchAtr times ATR away from the 50-period EMA baseline. For a long, price must be that far below the baseline. For a short, that far above it. This ensures the strategy is fading a genuine dislocation, not a gentle drift. There's one final confirmation. The signal bar itself must agree with the trade. A long needs a bullish bar, where the close is above the open, showing buyers have visibly stepped in. A short needs a bearish bar. Only when the cross, the regime gate, the stretch gate, and the confirming bar all line up does the EA send an order, and only one position per magic number is allowed at a time. Risk management is pure ATR. The stop loss is placed 1.5 times ATR beyond entry, and the take profit is set 2 times ATR away. There's also a spread filter that skips any signal when the spread is wider than 30 points. Let's read through the MQL5 code the way you'd see it in MetaEditor. At the top are the inputs. BasePeriod, STD-period, and STD-smooth-period build the adaptive dynamic momentum index, while MinPeriod and MaxPeriod clamp how short or long that period can get. Oversold level and overbought level, set to 30 and 70, are the thresholds the oscillator must cross out of. ViThreshold is the volatility regime gate. Baseline period and MinStretchAtr define how far price must be dislocated from the EMA baseline before we act. An ATR period, ATR multiple SL, and ATR multiple TP handle the risk distances. Just below the inputs are the two cross conditions. Cross-up is true when the previous DYMOI was at or below 30 and the current reading has moved above it. Cross-down is the mirror image around 70. Now the long block. The condition asks for cross-up, a bullish signal bar, and for the baseline minus the current close to be at least the required stretch. When all three are true, it reads the ask price, sets the stop-loss 1.5 ATR below entry, sets the take profit 2 ATR above, and calls trade.buy. The short block is the exact mirror. It needs cross-down, a bearish bar, and the current close to be at least the stretch above the baseline. It reads the bid, places the stop 1.5 ATR above entry, the target 2 ATR below, and calls trade.sell. Same structure, opposite direction. Let's walk through this illustration candle by candle. On the price chart, you can see the blue EMA baseline, our reference for fair value, and in the panel below sits the dynamic momentum index, the adaptive RSI, swinging between 0 and 100 with the oversold line at 30 and the overbought line at 70. We open in a calm state, with the oscillator hovering in the middle around 45. Then the first selling wave arrives. The second candle drops hard, and the third pushes even lower, driving price well below the blue baseline. Notice what the dynamic momentum index does. Because volatility has picked up, its period has shortened, so it plunges quickly, first below 30 and then deep into the oversold zone near 18. This is the exhaustion the strategy is built to detect. Price is now stretched a long way beneath fair value, and the volatility regime gate is comfortably satisfied. Watch the next candle closely. It's a bullish bar, closing above its open, and the oscillator turns and crosses back up through the 30 line. That combination is the signal. The cross-up from oversold, the confirming bullish bar, and price sitting well below the baseline by more than the required ATR stretch all line up together. The buy entry marker appears right there. The stop-loss is tucked 1.5 ATR below, and the take profit sits 2 ATR above, giving a reward to risk of roughly 1.3 to 1. From there, buyers take over. The following candles climb steadily back toward the baseline and beyond, and by the time we reach the take profit marker, price has reverted enough to reach that 2 ATR target. The long idea has played out, a fade of an exhausted sell-off snapping back to fair value. Now the market keeps pushing higher, and the setup mirrors itself. Price rallies strongly above the blue baseline, candle after candle, and the dynamic momentum index climbs past 70 into the overbought zone, peaking up near 85. Once again, the oscillator has reached an extreme quickly, thanks to its shortened adaptive period. Price is now stretched well above fair value. Then the reversal candle forms. It's a bearish bar, closing below its open, and the oscillator turns and crosses back down through the 70 line. That's the short signal, the cross down from overbought, the bearish confirmation bar, and price stretched above the baseline by more than the ATR requirement. The sell entry marker prints. This time the stop loss sits 1.5 ATR above entry, and the take profit is placed 2 ATR below. Sellers then step in, and the final candles roll back down toward the baseline. When price reaches the lower take profit marker, the short has hit its target, completing a clean fade of an overextended rally. Notice the symmetry across both trades. In each case, the strategy waited for a fast, stretched move, let the adaptive oscillator confirm exhaustion, required a bar that agreed with the reversal, and then managed the position purely with ATR distances. That's the entire rhythm of this approach. And of course, in live markets, not every setup resolves this neatly, which is why disciplined risk control matters. And that brings us to the end of our look at dynamic momentum index reversal. We covered how Chande's adaptive RSI shortens its period when volatility rises, why that helps it flag exhaustion right at the turning point, and how the strategy fades those extremes using a volatility regime gate, an ATR stretch filter, a confirming signal bar, and ATR-based stops and targets. Remember, this video is educational content only and not financial advice, a recommendation, or a solicitation. Every strategy carries risk, and losses are a normal part of trading. If you found this breakdown helpful, please like the video, subscribe for more MetaTrader 5 strategy analyses, and leave a comment telling us which strategy you'd like us to cover next. You can find more at www.algobot.live. Past performance does not guarantee future results. Trade responsibly.